What's up, guys? Welcome back. This is episode 33. I've got a good friend of mine. I've got Michelle Chu in the house, and she has a very long list of experience, um, both with marketing with Fortune 1000 companies as well as being a multifamily syndicator. So, Michelle, why don't you just kind of kick us off and tell us like how you got into real estate investing in the first place and kind of how you got here?
Right. Thank you so much, Adam. Love to be here and thanks for having me. I look forward to our conversation in the next hour. So, I am Michelle Chu. In the daytime, I am a marketing director of a global marketing agency that serves like Fortune 500 or Fortune 1000 brands. I have a fortune to work with a number of significant and iconic brands, including Mars, Campbell's, most recently Crayola, and also Johnson and Johnson and Samsung in the past. So these are like billion dollar businesses with multi-million market, I think, budget. And for example, some of these companies, just on the marketing side, can be allocating 100 to 200 million dollars just to make us remember their candies, their phones, and their TV sets. So what I do is to use a data-driven approach to run their e-commerce businesses and see what insight they can draw out of the very deep dig into the data and provide insights back to inform a strategy. So I guess I am always bringing this side of my world or this side of my brain to the world of multifamily syndication, which I spend my free time on, and this is also what I am passionate about. To a point that I would do it over weekends. So I pride myself in using a data-driven approach to do multifamily syndication, which means that I would be somebody who will be cracking the numbers, looking into things like job growth, population growth, like company activities in a local market or submarket to identify the next rising star. And I will work with operators and even builders, developers, to introduce these projects to our high net worth investors.
Yeah, and you said that so casually, like it's not a big deal to work with Fortune 500 or Fortune 1000 brands, but I mean, you had to start somewhere. So how did you get, most people I think only dream of working with companies that big.
Right. So, I am, this is very interesting story that I can share. Um, well, when I first left academia, I felt that I no longer want to teach at colleges. I no longer want to write a book that only 3 to 5 people in the world will read in a very narrow field. So I decided to get into a field that would fully utilize my left brain and my right brain, and it turns out to be marketing. And then there was also a short period of time when I was struggling to find my own direction. And I just go with my gut and think, if tomorrow's the end of the world, what I'm going to do. And my immediate answer was that I would go study something very deeply, which I am very fond of. And it turns out to be wine and spirit. So I actually start my marketing career by holding some wine and spirit sommelier certificates. And I start my career by doing marketing work for wineries. And then eventually I was offered opportunities to work with Napa brands that are all top 10 in the entire United States. And then I eventually got even more opportunities to work on bigger scopes with bigger brands. So I guess what I'm going to share with everyone is that no matter you want to take this take this seriously or talk about it casually, the most important takeaway is that you slowly roll up to another bigger thing with your small experience, because never undermine the value. To you it might be small if you're looking in a short time frame, but it is not that small.
Is that sort of how you rolled into multifamily syndications too? Because you and I both know from seeing in the communities, right? Most people are like, well, I need to start with single before I go to multi. And we know that that's kind of a myth. So did you roll straight into multifamily or did you decide to kind of ramp up to that as well?
Right. It's a little bit of a hybrid, I would say, and let me explain what I mean. So, I originally started 7 to 8 years ago in investing in single family residential properties. And then I take a long pause to stabilize my career and to take care of my personal matters. I came back to a different market like around 2022, seeing a lot of changes in the market that would inform me that my old strategy will no longer work. I need scalability and I need to grow bigger in a quicker pace with the right strategy, like thinking also about calculator risk. And that's why, while I still manage a very small uh, rental portfolio on the residential side, I start like doing a lot of things to break into the multifamily world.
I like that. I like that you said that you take a calculated risk because I've done both, right? Like I've taken the big risk of being an entrepreneur, and now we're taking calculated risks to acquire like RV parks. What kind of multifamilies are you syndicating for? Like what kind of classes are you in? What kind of markets? What does that look like?
Mhm. I focus on apartment buildings because I feel that like no matter whether we are going to shop or not, no matter whether we are going back to offices or not, we always need a roof above us and we always need a place to stay. So I personally is pretty fond of market that has tech-driven jobs that are backed by numbers or data that would inform me that there is a believable job growth and population growth. And there I focus on apartment buildings that are in like class A or class B. If it is in class C, I would expect it to have a value add component to it, which would justify the numbers and justify the reason to acquire that asset. So, for example, I am now working on a Class A deal in Louisville, Kentucky, which is a complete new build, and the operations team is buying it directly outright from the builder. And this is a like rarely seen opportunity that can deliver almost the same kind of or same or comparable level of returns to investors as a Class C value add, while it is Class A and like with very minimal like CapEx and also repair expenses in the upcoming 5 years. So yeah, this is just one example of the many that what I'm doing.
I wouldn't have guessed Louisville would have been a good tech market. I know I've seen examples of like Dallas, Phoenix, maybe even like North Carolina. Um, so that's interesting that you say that. And like you said, it's a ground up. Um, I got the chance to look at and help Avishkar with his offering, which was a similar thing, like downtown Dallas, ground up, Class A,
Mhm.
luxury apartments next to Goldman Sachs and all that kind of good stuff. What kind of units or what unit numbers are you usually acquiring with?
Mm, I usually look at assets with 50 units or above. In the example I gave just now, it is a 138 townhome community. So yeah, like I would say like most of the deals like we underwrite or we look at can be ranging from anywhere from 8 million to 30 million. And like it has a different component to it. And like the very interesting thing I always tell my investors as well is that different projects are all slightly different in their own ways and like they is a different business plan to make money. So to me there is no two projects are the same, and at the same time like I think it is my responsibility to explain to investors clearly what different business plan looks like and which makes up the different risk profile or like risk like consideration of an investor, if that makes sense.
That does make sense. So let's dive into that a little bit. You know, if I had a property, let's just say it's 100 units and it's in your range, maybe it's $12 million. What does that syndication look like? What kind of numbers are you diving into? What are you trying to like? What kind of data analytics do you do before you start the syndication start to raise?
Right. So like I am a I am a believer of both combining like both macroeconomics and microeconomics. So like there are several like tools and tactics that we will do in our analysis. If we are analyzing like the macroeconomics of the market to the point of even we are predicting the future growth of rental units demand, then like we will be looking at things like job growth, population growth, and also like one metric that I really like to use, which is available to download conveniently from the internet, is what it's called LQ, location quotient. It is actually a number that is published by the Bureau of Labor Statistics, the BLS of the US government. And it will, the like all the idea is that like it is a calculation or it is an expression of how strong certain employment sector is within a market. So this means that if the if that employment sector has an LQ of about 1, it is very likely that it is hiring more people than the neighboring areas, and it is so strong that it can export that kind of service to neighboring areas as well. So like using LQ, it is very convenient for us to identify winning employment sectors in a certain market. And we go from there, we identify whether they are important big employers in those employment sectors, opening new offices in that area, bringing new jobs.
So if the market you're looking at or a nearby market does have an LQ of +1, how far of a radius does that typically affect as far as the metro area?
Yeah, good question. So like well like we go by the government's like definition of an MSA, which means that you will be getting an LQ of an MSA. If you are investing in a tertiary market, there is a chance that there will not be that government published data. But like if you are like looking into a sub-market that belongs to one of the many MSAs that the government set up in their for their census and for their bureau statistics purposes, for example, very likely you will be able to find the data you need.
And so an MSA would just be like a major metro area, or is that
Correct.
like very specific metro areas?
So far from the data that I have cracked and I have seen, we can go very deep down into one city if you're lucky. But like most of the data, like is a expression of how strong a job sector is in a certain MSA.
I ask because I'm curious, like if they would establish an MSA around smaller cities as well, right? Like it would be obvious that they'd probably have those labor statistics for Dallas, Houston, Seattle,
Mm-hmm.
um, San Francisco, but like I'm in New Orleans, which is a much smaller city. So do they crack into that data on smaller cities too, or is it just probably like say a million plus population or whatever?
I think for New Orleans, like there will be data, for example, because like it has an MSA setup.
Nice. And it sounds like you guys are really getting into the KPIs of that. That LQ is sounds like it's probably your hidden weapon as far as data that people are probably overlooking.
Mm. Well, Joel, thank you for your kind words. Like I'm not sure whether like I would call it a like secret weapon, but I have to acknowledge that like I learned this from a lot of great people, great teachers, like from who are like also in the multifamily world, and I'm in debt to their teachings.
Have you acquired any multifamilies of your own yet, or are you just syndicating for, other people?
Right. I own a small portfolio of like a mix of residential and small scale multifamily, which means like duplexes like on my own. I currently like have assets both in Washington and Ohio and looking into expanding into the other states.
Nice. And so then, that's what we would look at before the syndication. Now, let's just say you and I find a property that we're going to go into together. How are we setting up that syndication? What are some of those first steps that we're doing?
So, like, for the very first question is actually to step back to see whether syndication even makes sense. Because, like, for some of the deals, it is totally possible that like people like can come in a joint venture agreement rather in a part to define their partnership. Meaning that like if like the deal is on the smaller side, for example, and like partners are trustworthy enough to form a partnership that does not need to go to a syndication route, they can totally skip that step, come together, pooling their own funds and acquire the whole thing. So, like from a management perspective, like this could be easier, but of course, the complexity can also come in other ways. For example, what happens like when partners in the future down the road runs into arguments, like how are we going to kick someone off an LLC or things like that. So like this is a process that like would require a very um, carefully defined relationship through the legal documents. Probably you will be building like things regarding like voting rights, and also like your also like percentage share, for example, into your operating document of your LLC. So if we go into the other route, meaning that we we decided that we want to syndicate, then we actually will need to understand that we will need to follow a number of rules laid out by the SEC of USA, because like the SEC like in one way or another count you as like involving in securities, and they bear the responsibility to protect investors. Then like we're talking, then like we will have to follow the SEC rules to see how much money you can raise from investors, which would become the equity of the asset. And then for the rest, it will be mostly be financing or debt that you will work out with a commercial lender.
Okay, great. So hypothetically, assuming you and I have a great relationship, we're on an LLC together, we're consulting an SEC attorney. What are we looking at next? We're probably talking to multiple lenders to secure the debt product, and we're going to syndicate, you know, like you said, probably whatever the SEC will allow, which I know is what, probably about 11 investors on a single syndication. Is that right?
Right. Well, probably more than that. So, like, let's separately talk about what happens to the equity and what happens to the loan, because being a partner and being a lender in a deal are actually completely different things. And I think a lot of people are still having a lot of confusion, probably because on the residential side, if we want to fund a deal, people can be looking at getting a PML, meaning a private money lender, versus a PMP, a private money partner, in almost the same way. But in the commercial real estate world, it is not correct to look at that way, because like equity and loan are completely different things. So let's start from there. When we talk about equity, we are talking about these people bringing in funds and being a part owner of the deal, which is expressed by having a percentage share of the LLC that holds this deal. So this means that like there is more likely if the deal is running in an optimized way, these people will be enjoying an upside through the operational success. And that is what a partner means. So like what you need to, so like on the equity side, this involve what we call capital raising, which means that you will be finding investors, convincing them to be on this journey together with you because you guys are now business partners. And then on the loan side, of course, you will also be securing a commercial loan from an institution that would issue that loan. In most cases, commercial real estate, the loan actually like approval process would involve looking at what a document, what is called a SREO, SREO, or like people just can be spelling it out as SREO, which means Schedule of Real Estate Ownership. This actually means submitting almost a resume plus a personal financial statement stating that how much assets it's under your name, calculating all the investment, all the assets, insurance, stocks, but minus your primary home to calculate how much of a loan you can back. And it is because of this, the GP team, the general partner team, who will be responsible for operating this asset, meaning working with the property management company to make this deal a success. Technically speaking, will be putting out their balance sheet to back a loan, and they together their sum up net worth should be able to back a commercial loan.
Right. And because the people operating would be your GPs or your general partners, that would make your investors who are taking equity, your LPs or your limited partners, right?
Correct. So I actually have this like a question from a very sophisticated investor yesterday as well, which is also a good reminder for everyone. Uh, when you are a GP, you have voting rights because like you are responsible for the operations of the asset. And if you are a limited partner, if you're an LP, you don't have voting rights. But in exchange, you are completely off the hook for all the operational responsibilities because it is on the GPs. So it doesn't. So like to me, a lot of people can immediately be jumping into the team, a deal, rushing into opportunities to becoming a GP. In reality, if you look at the multifamily world, there are many people who will stay as LPs forever. Very often, those are ultra high net worth people who have a lot of things going on. They have multiple stream of income, and multifamily investing is only one of the many for them. I mean, many here. So because of this, they can be investing uh, investing in multifamily deals forever for a very long time. And some of those like sophisticated LPs, they are really professional investors that sometimes can know way, way more than a GP would.
Yeah. And the LP is, like you said, is probably one of the best routes for people that are looking to passively invest. Like, I think that's probably one of the few streams that is, I would classify as generally passive investing.
That is correct, Adam. Like I think like we can all testify that if you run your own portfolio, if you own something 100%, it is not completely passive because you have to manage your tenants. So becoming an LP instead on a multifamily deal, I would say is like I would let me rate it. I would say that it's 70% passive or 80% passive. Why the 20% is deducted is because it's your responsibility to vet the GPs and it's your responsibility to review the deal's underwriting and to vet the deal.
Agreed. And like you're saying, it's a really good opportunity for the sophisticated investor, which is part of the reason why there's accreditation rules in place. What
That
kind
is
of
correct.
options do you have typically if you're not as accredited, maybe, or if you're not accredited, or if you want and you still want to get into the LP world, like where could you find those deals?
Right. Well, connect with us. So there are so like what happens is that SEC used to like lay the rule that you are either a 506B deal under their code or a 506C deal under their code. 506B means you can take up to 35 non-accredited investor, but everyone in the deal must be your friends and family and must be someone you have substantial relationship with. A 506D deals mean everyone must be accredited, but you can raise capital from people who you don't know very deep yet. So the new trend now, what is happening is that a deal can be starting on the 506B first, getting like friends and family into the deal first, and then they switch to 506C. So they are allowed to finally post on social media, run ads, and to like massively broadcast about the deal. So like what I would recommend for people is that in case you are non-accredited but interested in these kind of opportunities, what we can do is to match you to a 506B deal. They can be a 506B deal that stays 506B forever. They can also be deals that would start at the stage of 506B and you have to get in before they switch to a 506C. So this would be something fairly new and more operators are doing right now.
You mentioned in there kind of passively, and I wanted to put the emphasis on this that 506B, because of that substantial relationship, you cannot market it. It's really like it is your network completely. But like you said, the 506C, where you can market it, but you can't bring in non-accredited, right? Because that was the SEC's kind of delineation to try to limit the use of things like Ponzi schemes.
Correct. So one thing I would lay out as well is that whether you can post about a 506B deal on social media private group that is not open, uh, it, which means it is a private group for a close community, is a little bit in a gray area. So I cannot speak for other people, but I would say that like if I come across a 506B deal, I will not post anything on social media about this deal, regardless of whether the groups or the platform is open or closed. But yes, of course, like this means that like I will have to build a substantial relationship with everybody before they get into the deal. This means that it is my responsibility to find out who you are, what is your background, and how you are making money day to day, how what is your job or your professional background is like. So we have a pretty good idea whether like this is a risk that you can take or not.
Yeah, I was gonna say that's the other gray area is that substantial relationship is not well defined in those regulations either.
That is correct. So like, but I would say like you saying hi to that person, cold outreach to that person, like on LinkedIn DM, for example, may not be enough. But like at the very least, like book a call with them, um, like talk to that person and see what that person's professional background is, and get an idea of how that person makes money to plainly and bluntly put it. Although like it sounds impolite, but like this is actually what like SEC want you to do.
Yes, they want you, well, that makes sense because they want you to kind of understand the sophistication level of the investor, right?
Correct.
Like if you and I were on a hypothetical call right now, you'd be asking me, well, how do you make your money? And that, let's just say it's through my small business and some RV parks that I have. Like, okay, now you understand that I've invested in RV parks. Therefore, I have some level of sophistication as far as investing goes.
Correct. So like I will be asking questions like, oh, like how do like what do you do in your professional job? Like how long have you been doing it? How many years of work experience do you have? And also I will be going a little bit deeper and say like how are you handling your investment right now? What kind of things you are more interested or less interested in investing and how you are like working with like deal owners, operators in vetting those deals. So that way it informed me like how like sophisticated you are, although I really hate that word. Or like I should put it in a better way by saying that like that would give me a better idea of um, whether this is something that you fully understand your risk. This and so in this regard, I don't think like we are against the SEC. I think like we are partnering with SEC to protect our investors, because like the point is like honestly for everyone to make money and to bring good deals to the market because like it is I have to admit, it's unfortunate that not everyone is doing it in the field.
Right. And well, and to your point, even if I'm an accredited investor, but my only investments have been treasury bonds, now you're like, this is not the right risk match.
Yes, but like that, but like, but like, despite that, will you be eligible for investing into a 506C deal? The answer is yes. So so I guess in those situations, for example, I would answer a lot of questions from investors. In fact, like I was just on the phone yesterday, almost all day long, explaining a lot of things to investors. But like at the same time, like you know that if an investor asks you a lot of questions about how these things work, they are actually pretty serious. So like these will be contexts that you may want to keep follow up again and again, and even to ask them to introduce like friends and family to you, start to build relationship and have a conversation with them, just to see like whether like they will be interested in bring in like participating in this kind of investing, and then uh, and then see whether there would be a deal that matches like their risk profile.
What are some of the common questions that you do get from investors when you're on these calls talking about, risk profile, risk mitigation, deals, vetting?
Hmm. A very, very common question is that why do I invest in real estate when I already invest in stock and bonds? It is like maybe the number one question that I am getting. But like one step back, one of the reasons I am always getting this question is actually tied to the fact as well that I raise capital from a lot of tech workers who are based in Silicon Valley in Seattle. And these are people who are paid a lot of money. They are their salary is very high, but at the same time, they are also getting a lot of stock options from their big tech company, employers. So the very first thing they would always be comparing real estate against is actually stocks. So just to give everyone an idea, this year alone in 2024, S&P 500 is up by 30%, which means that if you buy an index fund or if you buy like a tech stocks, for example, just throwing money out there and do nothing, there is a very good chance that you are making 30% and and you don't have to do anything. So a lot of people have a very strong feeling that the stock market is up and might continue to go up. And there is actually a less of a reason for them to invest in real estate. So the answer I always come up with them is that if you feel that you have made a lot of money from your GameStop, for example, or from your Nvidia, good for you. But at the same time, if we're serious about investing, probably the right way of thinking about it is to have a diverse portfolio of different investing and vehicles or different tools in your toolbox. So while I would say that like there is a chance that like real estate it may not be making as much money as you make in the stock market right now at this moment. But like remember that real estate is also less volatile. And at the same time, if you exit at us, if you exit by selling stocks, you have to pay a pretty heavy tax. But like in real estate, there is depreciation that hedges like your earnings and like would probably like give you a lighter like tax burden. So like these are also good things like to consider. So like I would recommend like people to have if they already have stocks and bonds. Of course, I'm not going to ask you to sell all your stocks and switch everything into real estate, but it would be great to have a mixed portfolio and to like have different tools in your investment portfolio. But again, this does not mean that I am encouraging everybody to drop completely what they're doing right now. I am not, and no one should.
Yeah, but it sounds like that's your primary weapon, I guess, to convert them over from being solo stocks and bonds to maybe you should be a little bit more in real estate is the stability, right? Like you said, it's more of a medium risk, medium return, but so it's not going to be super high yield, but it won't be super low yield, but it will be secure. It's always going to be there and it's always going to appreciate, and you're going to be able to take those tax benefits over time.
Right, exactly. Our team actually has reviewed a report done by McKinsey a few years ago, which is like the largest like business consulting company firm. And I can share the link with everybody like who is interested. Based on their studies, it has found that out of the 10 deflation or economic downturn periods in the past 70 years, uh, 7 out of 10 periods, we see that real estate outperforms all other investment vehicles, including the S&P 500 sometimes. So I would say that like it is a hedge. It is a good mix to have in your portfolio and in your toolbox. And I don't think that it is fair to directly compare stocks to real estate because they are just not the same thing.
I would agree, but I do see that as a common tool that people will use is they will say, well, S&P on average returns like 8 to 12% a year. Like I can get you double digit returns in your real estate portfolio.
Right. So it really depends on what projects you're touching on as well. Well, from time to time, I do come across projects that like the IRR can be very close to 30%. But those are like very special cases because, for example, those project touches on opportunity zone that gets a very good tax breaks, or like those projects have a very short turnaround time to do rehab or construction, which would give money back to people in a very short period of time. So like again, the like business model is a little bit different. So like we can always come and have a discussion and talk about like what you like and what you don't like, and also what your risk profile is like.
What's the typical IRR that you're seeing on projects that you're touching, just to kind of give people some realistic expectations?
Mhm. Typical projects that come across my desk are at around 7 to 8% cash on cash return, which is above your savings account, like which is now offering a 4.5 or less than 5% interest rate. And they typically come with a 15 to 17% IRR as well. And most projects I touch on has a 2x equity multiple, which means that within their whole period, there is a very good chance that we project your money is going to double.
So with that cash on cash being a 7 to 8%, would what makes up the rest of the 15 to 17 on the IRR, would that be from the tax benefits that they would receive on their K1s?
Um, the the way to think about IRR is this. IRR is actually internal rate of internal rate of return, meaning that we instead of like taking into your account your earnings, we are also looking at your whole period, how quickly you're making that money. That which actually means that if you see a deal with a very, very high IRR, it actually means that your whole period, it's either that the whole period of that project is very short or that project is doing phenomenal. So that is how it looks like. So when we say that a typical project has a 17% IRR, one additional explanation that we have to make is that how long you're holding for a project. For example, like in the Louisville project I was talking about as an example just now, um, it actually means that within the 5 year hold period, as in the business plan, we predict a internal rate of return year over year at 17%. If we take into account all the distributions you are going to receive every quarter, plus the money you are going to make at the exit when the property is sold. Then when we dial that back into the past 5 years, your total earnings will be roughly equivalent to a compound of 17% year over year.
So if I've never invested in a multifamily before, what does distributions look like? What's that schedule? How do you determine the distributions that people get?
Mhm. Every project is completely different. Most of the projects, if they have a value add component, there will be a 6 to 9 months of stabilization period, which means that you are not getting any distribution in the first 6 to 9 months, and it will happen at the end of 9 to 12 months. Depending on the structure of the team and how they work, most of the operations team makes a distribution quarterly because it is the most cost effective from an administrative point of view. So this means that um, like when and how you're going to get distribution back from the operators would depend on like how much like rehab or construction work that has to be done, how long the stabilization period of that project will be. And you, for most projects, it is more likely than not that you will be getting a quarterly distribution.
And what do those distribution percentages usually look like? And I know that, like you said, they're totally wildly different from project to project. But what's kind of what you've been seeing across the projects you've been touching?
So for most of so that actually is roughly equivalent to the cash on cash return. And so like most of the projects I am seeing right now can be making a can be like making a distribution of around 6 to 8%.
That makes sense. That's about what I've seen is roughly around an 8% preferred return.
Yeah, exactly. And then another thing that like makes multifamily investing interesting and also favorable to LPs in one way is that LPs gets the distribution first, which means that if the project makes money, it is always an LP that gets the distribution first before the GPs and before the operators. Then this actually forces the operators in order to like be fair-minded to passive investors to really perform because like if the asset is not performed well or is just performed enough to pay back the LPs, the GPs are actually not making money.
Yeah, so it lights a little bit of a fire under their ass, so to speak.
Right, exactly. And then again, going back to the example I gave just now, which is a 138 townhome deal that we are working on right now in Louisville, Kentucky. Um, Another pressure on we operators is that we have to keep the vacancy rate above 90% because like that asset is now at a occupancy rate of 95%, making us eligible for a Fannie Mae loan that is 5 years interest only. And like it has also a very attractive rate of below 6%. So this means that as operators, if we don't want to lose the eligibility to this loan that is favorable to our business plan, the pressure is on us to make sure that like most of the units are rented out. Then this will deliver results to LPs as well.
So it sound because that was going to be my next question was going to be what if you do have an asset that's struggling, what is the main points of turnaround? And it sounds like keeping occupancy as high as possible, or keeping vacancy as low as possible. But is there anything else that might go into that as far as turning an asset around?
Yeah, from an asset management standpoint, there are a lot of more creative things that you can do. And ideally, you don't want to just do it when you are in like horrible situations. You probably want to think about those things when you are doing your business plan, when you're underwriting. That is even before you successfully acquire and close this asset. So there are several things that we are seeing in the front line in the market right now that like would be great to share with LPs and even other operators. For example, uh, low flush volume toilets to be installed in units because this would reduce the water fee. So another interesting thing would be to install QR codes or electronic payment options in laundry rooms. Because like that would best avoid people like stealing coins or stealing money from the coin boxes in the laundry machines. So another thing, of course, like would be bigger would be improvement in amenities and also like improvement of like pavement ways and also parking lots, which would also increase rents and also like increase the satisfaction of renters, encouraging them to renew their leases. Finally, one of the very big thing that I think like it has become the world that no operator should miss, pet fee. Pet fee is now increasingly a big thing, and like a lot of operators are doing that right now, charging a pet fee. And if you are not already doing that, you should.
And so, and just to specify, is that the pet fee as in like a pet deposit, or is that pet fee and like pet deposit and pet rent? Are you seeing that with both of those?
Yep, I'm seeing both of those. It really depends on the business plan and like how much you think that portion is going to increase like the additional income on top of rents.
Yeah, Chris says that he's used it before for repairs as needed, which makes sense, especially if you underwrite it for, pets vacating or pets occupying a space would have a certain amount of attrition as far as how much damage is done
Mm-hmm.
as opposed to just humans occupying the space.
Exactly. So like and also like interestingly, and this is something we only are able to see when you are working on this in the front line. There are certain markets or certain areas that are more prone to pet damaging floors because of floods, for example. For example, like I have assets in Columbus, Ohio. A lot of our units there, if they are class C or B minus, would actually need carpets redone or even like hardwood floors redone from time to time because of pets. So like if you are not charging in the pet fee, probably you're not like fair-minded enough to yourself.
Okay, so is that kind of the biggest thing you're seeing is probably floors, maybe even baseboards or like damage to doors from pets?
It really depends on the area, but generally, yes. And then I'm not well, like, but like on the upside, of course, like it really also depends on which area you're in and what the demographics looks like. For example, we have been into markets with access that um, the demographic in general has a higher proportion of like Hispanic families, then you will know that you really need to budget something at the very least to amenities because like they are a tightly knitted families. That family bonds are very important to those tenants, and amenities would be something that would they would really enjoy, which push them to renew their leases as well. So like and also like but of course like in general like they tend to be longer renters if you are able to like keep them happy in the rental properties as well. So like in this regard, like having some basic understanding of the demographics of your renters would also help you make your best business plans.
That makes a lot of sense. And so I'm guessing, like we're saying, when you're underwriting this, you're figuring for every time you turn a unit, you're probably looking at what, like floors, fixtures, lights,
Mhm.
paint. But with pets, maybe you just redistribute that. You say, I don't know, $20 a month per pet for pet rent and a 250 non-refundable deposit to kind of alleviate that, plus maybe then a little bit of additional attrition
Mhm.
on when
Right.
turning units.
Mhm. Right. But like one reminder though is that when an LP evaluate a business plan or evaluate a operator's like mindset, remember that upgrading and also remodeling is not always the best. What I mean here is that a good operator should also be considering the supply and demand of that area for rental units and not over remodeling things. Because like there are, we have run into like deals when we underwrite a things in that I a like a building or an apartment building is for sold, but like down the street there are already 3 to 4 um, other buildings that are renting for um, like roughly the same or even a little bit lower rents, but like they all have upgraded appliances like stainless steel appliances, newly remodeled units everywhere. Then like it would be and then like you will have to think about whether you should match them by also having stainless steel appliances and like have the newest kitchens and bathrooms just because you want to be them. Sometimes the answer could totally be no, or maybe this is even a deal that you have to walk away because like with the demand so high over there, or like you do not have enough supply to eat up all the rental demands.
Right, especially if you're only making X amount on each unit or whatever. If it's a slim margin, you're trying to either maintain or replace, couple $1,000 appliances. Those two things don't really mix together.
Exactly. So these are the things we operators are thinking. Supply and demand, absorption, and also how far you are from the market rate. So you decide on the delta of how much room you can really push the rent up. So, and these would all inform your business plan decisions.
So how would you evaluate that? Let's say you're looking at the delta of a unit or a property right now. Like what kind of things would you consider?
Right. So I would say like I always do a dual check. Uh, of like my numbers. What I mean is that I first go to like our data tools, such as a Cracksy or a CoStar, to look at the numbers. These are actually databases that has already collect a lot of data at of a certain area and MSA, and sometimes it can even broke down to a specific zip code. And then the second check will always be go to your local property management team or local property management company. It would be ideal if you can get hold of a property management company that is already managing another asset, which is very close by, because like they will be giving you the most accurate numbers. Then in this regard, like you can compare the numbers and see which one is closer to the real one. So here I would say there is actually one very important thing that we have to mention, which is like some misunderstanding when it comes to underwriting. And I think like as we all learn and grow, now a lot of people have a better understanding of what underwriting actually means. It actually means running numbers to see whether a deal works or not, and to decide whether to move forward with it or not. I would go further and say that underwriting is actually a data collection and a research process that you, is not set it and forget it. In the world of commercial real estate or multifamily, underwriting is actually something you will have to do maybe 6 to 8 times before acquisition, because what you will find is that you will keep comparing different data sources. You will talk to your property management company multiple times. You may even compare your numbers and do underwriting together with your lender and your property management company multiple times. So actually, it is a very long research process. And for people who are trying to get into multifamily, I would also advise that to have a paradigm shift about what underwriting really is. My experience tells me that because I'm not afraid of numbers, I am pretty good with Excel. So I start learning about multifamily by going into deep diving into how to do underwriting. But in reality, if you have asset management experience and then come back to underwriting, you will actually start to think that each number in the underwriting sheet represents exactly one part in asset management, and there is a meaning to it. So, in fact, I would say that in case you're starting in multifamily and in case you're starting to learn about this by learning how to underwrite commercial deals, it is actually a good way to learn by first going into the underwriting sheet and then like have experience and in asset management and then come back and review what you have learned to a point that you may actually need to unlearn what you have learned because you will have a different understanding of underwriting now when you have asset management experience.
Yeah, so you mean to tell me it's not like single family? I can't just go get ARVs and rent rates and call it a day?
Yeah, unfortunately, no. Like for a deal to work in multifamily, very often an underwriting process can be months, just because it is a process to collect information. Will there be AI tools, or is there AI tools that can help you cut down that time? Yes. You may came across um, tools that are very good and will be able to collect all the data for you, put that into a spreadsheet for you to look at. But what often happens is that most accurate number still comes from people on the ground. So you will have to work with them closely. So like you may be saving time in the front by using AI or using digital tools, but you still may not be able to skip the line, save time by not working with the right people on the ground.
And one of the other things you brought up when we were talking about underwriting is property management. So what's some of the few things that you're doing, in working with them, but also like in vetting them to make sure that they would be good with helping you with your asset?
Right. Well, like it is very interesting. I think like a property management company can really make or break a deal. So it would be very important to work with good ones. The challenges sometimes is how to identify a good one. So I would say sometimes like it is interesting that from our experience, going to the biggest markets may or may not be the best all the time. Sometimes it still makes sense if you go into a tertiary market, but if you can get hold of a good property management team and work with them and like turn an asset around. So by then, like although it is a tertiary market, it may not be as well known as like famous hubs like Dallas, Austin, Seattle, or San Francisco. There is still a very good chance that you will be making money just because like you have the right people on the ground and like the demand there has not been met by the supply.
Yes, that sounds like you just said a little while ago that having all the right people on the ground is what really can, at the end of the day, makes or breaks the deal. Not just the property management, but your own team. And so, what are you doing to kind of build your team?
So, well, like I think a lot about like what is the best value of my time and what would be the things that like other people are also good at. So, I think like the very first thing I would be looking at is people's integrity and people's ways of working. Because like the thing tricky about multifamily is that it is a team sport. You really, really have to work with people you trust a lot. Because like we're talking about multi-million dollars here handled. So I have personally walked out of a deal like in Illinois, like in my very early stages of my career, just because like I discovered some like dishonest behavior of the co-GP teams and like and or the seller, and and so like these are the things I would be looking at. And one thing I would always confirm is how much how much that person is willing to teamwork. And if I confirm that they are very willing to teamwork, I will be like telling them that, okay, although I can do underwriting and asset management at the same time, I would prefer not to do that. And I would honestly tell them that I think you are a better expert in the team to do underwriting. Let's have you do it. It's not that I do not know how to do underwriting, but I think you are a better person to do it. So this way, it is a conversation that should be built on trust and also different people's expertise. And then like and then and the ideal outcome should be everyone doing what they are the job that they are best at in order to put all the heads together.
Yeah, that's a really good point. Is putting the right people in the right seats to make sure that everything
Mm-hmm.
flows in the way that it should. I can't imagine that that was easy
Right.
for you to walk away from a deal because of a code GP team, though.
Right. I've done it multiple times by now. I have walked out. I've walked out of a 15 unit deal in Illinois. I have walked away from an 80 unit deal in Florida. So I don't mind in sharing like my stories of failures because I think there isn't enough people out there talking about why some of the deals fails, making multifamily investing a very rosy or overly rosy. So, well, I would be very honest. Like, what happens, like in Illinois at that time when that was very early on my career, is that we are blocked by several challenges. We discover that like the seller is dishonest, trying to use the sale of the asset to our team to hide some of the liens that he is responsible for. And at the same time, we are faced with, unfortunately, racist property management teams who would refuse our business. So
Mm.
I am usually not the person who would think about these things or who would be oversensitive to racism because I just believe in people's integrity and people's talents in general being well respected. And I come from that professional world myself. But like it is so unfortunate that those like traits of racism has become very obvious when like my Asian partners make a call, they said no to our business, but they immediately pick up a call from like our male white partner, for example. So which is really unfortunate. Yeah, and then they dominate the market in rock and like I think it's in like they know they dominate the they dominate the markets like in a like tertiary market in Illinois, unfortunately. So yeah, so this is what happens. And for another time, like for 80 unit deal, I discovered that one of the co-GP team members are actually in debt for over 100K with like loans and credit card debts. Like and but like and also like there are some like discussions that happens behind the doors like without involving all the GP teams, making me wonder that like how honest these people would be, and like I also question greatly whether these people would be uh, like great handlers of other people's money. So I walk out of in these two situations. Like in the Illinois deal, I unfortunately have to forfeit the EMD. So like I suffer from the financial loss. And for the like 80 unit deal in Florida, I did not suffer from anything. I walk out away from the deal before I make any investment, and none of my investors uh, suffer a financial loss either. But yeah, no matter which way it is, like I feel that I have made the right call for my investors, especially in that Florida deal.
What was the most difficult deal you had to walk away from? Because I find this is where most investors find themselves, right? Like you're saying, like racist partners or dishonest partners, maybe somebody that has like a felony theft on their record. Those seem like very obvious cases of like, I shouldn't be in this deal with her. I shouldn't be in this
Mm-hmm.
deal with him. But most people find
Mm-hmm.
themselves in that weird gray area of like, I mean, you, I don't know. It's still a really sweet deal. Maybe I should stay in.
Well, yes, I think like this happens a lot and happens all the time. So like I would be brutally honest about several things here. One, deal is a deal. You can be emotionally invested, but not overly emotionally invested. Believe in your numbers, check on the rational side of your of your mind. Another thing I would be very brutally honest about is the reality of multifamily. Multifamily is actually a long game, and most people see their biggest paycheck only when they go through the full cycle exit, which means that um, the money will come, they will, but only in around 3 to 5 years, or even 7 years sometimes. And in the middle, you are enjoying cash flow, but sometimes like it is fewer or it is less than your assignment fee if you're doing wholesale, for example. So like what I would recommend is that if you really want to get into multifamily, actually you would be in a better position to protect yourself if you have a W-2 job or if you have other streams of income. And yes, you are going to have a very, very big paycheck and you are going to build a lot of generational wealth for your family. But before you reach that point, you really need to take care of yourself. And I would say that although this is although a lot, I would say not a lot of people talk about this, but like I would rather be very honest and a little bit brutally honest about this.
So let's just say, what would you tell that partner or that person that comes to you for the advice, right? Like, Michelle, I got this person over here. We're thinking about buying 250 units. I'm just not totally sure on their character, but it still seems like a good deal. What kind of advice do you give those people if they're thinking, because like you said, like a deal is a deal. However,
Mhm.
if you're not totally down with that person, if you can't jive with that person, if you can't work with that person day in and day out, especially when things get hard, you're stuck
Mhm.
with them for 3 to 7 years.
Right. So exactly. So this is the thing you don't want. And like there you will basically have two options. One, to walk away from the deal. And the way to tell yourself this is well, you would rather want to walk away from the deal and look for the next goodie rather than being married to a deal or to the wrong people for the next 5 to 7 years, because this is what happens with multifamily. You cannot walk away from the deal easily once you get into it. Your another option is actually to break off from everybody else in the team and bring a deal to a key to a like key principal or a KP who would have a high enough balance sheet to back you to run the deal. They would be getting like, of course, like a share of your deal, but like this going this route may like save you some effort from looking for another deal and will still be and you will still have a good chance of saving this deal and making it work. But the caveat here is that how realistic this scenario is. KPs are people who have to vet you before they work with you. You actually need to start building relationship with some even before you have a deal. So like if you have not started, if you are not in the multifamily world already, building relationship with KPs or learning how to find these people, uh, because like these people are high net worth people who has in a high enough balance sheet to back a commercial loan by themselves sometimes. So
Mhm.
like in reality, if you have not done the pre-work of building prior relationship with these people, this is not your option either.
Yeah, and I'm guessing, especially when you get into assets that big, your options for KPs become limited.
Right.
You know,
Mm-hmm.
an
Yeah.
example of a KP could be somebody like Pace or Abraham that has obviously a tremendous balance sheet that they could get the loan any day of the week.
Mm-hmm. Right. Exactly. And then yeah, and then like this way so like so like I would say, so my advice to like people who run into this situation is that start building relationship, KPs will not back a loan easily only because the deal is good. They would actually need to vet you as a person and make sure that you are the right person to work with. And this would touch on your personality, your ethics, your integrity, and even your work style. So these are the things you actually need to show somebody even before having a chance to talk to these kind of people and also having a chance to work with them.
Well, and actually, to give a very real example, the RV park that I went and toured a couple months ago because we were interested in acquiring it, we were going to utilize a KP on it, and it was a much smaller scale. The loan would have been for like 650, but I mean, a KP is a KP is a KP, right? Like they,
Mhm.
but she had the effects and the ability to be able to go out and get the loan on her own if she wanted to. But like you said, I had been building that relationship for most of this year, for at least 6 months before I even walked that property.
Mhm. Right, exactly. These are the prep work that you have to do, and prep work is always be should always be done even before a chance appears.
Yeah, so you're always networking with people.
Mhm.
You know, and you'd be amazed at the amount of people that are in the communities, you know. I know of probably at least two people I can think of off the top of my head, maybe three that would be good KPs. But like you said, you have to build that relationship with them, probably laugh with them, break bread with them,
Yeah.
have a beer, do something.
Exactly. So yeah, a lot of them are actually really smart and really successful um, business owners, or a lot of them have been in real estate investing for a long time. Many of them has a very high paying W-2 job, meaning that they have very, very top in the corporate ladder as well. So for those people, honestly, they are very good at reading people. Sometimes just by talking to you, they already can figure out who you are and what your personality is like. So I would say in front of those people, it's really hard to hide who you really are. But like just be yourself, be genuine, and be humble. They are good people to learn from. Just stay humble and learn from them.
I found one of the best things that works is humor. As simplistic as it is, it seems to be the thing that binds all of us together. Like if I can make you laugh, like you're mine. That's it. We're friends now.
Right. Well, I use this tactics too. It really depends on how serious that person is. Like, have I encountered like in situations that a joke doesn't work? Sure, but most of the times, yeah, I agree. It works well. It works well than not in most of the times. For example, like our team has recently run into a Facebook ad that we got targeted because we're obviously the right audience of like a capital fund saying that like GPs are allowed to join a fund with no work with no responsibilities. So and everyone under that Facebook post or Facebook ad immediately say that this is a violation of SEC rule, and some people even tag SEC websites and also SEC Facebook pages. So this would be like this now becomes a joke that I would share with other people, saying that like these are the things that we actually are very careful of, because guess what, we don't want to be one of these guys.
Yep. But I do find that humor and passion go a really long way. I would say that was the other way that I connected with good KPs was one of them. We were sitting down at the sports bar at Quad Up Summit last year, or this earlier this year,
Mm-hmm.
and he could tell that I was just shooting him straight, and that we were talking about raising capital and how ridiculous some of the requests can be from the borrowers because they don't give you anything.
Right, right. So I would say one of the KPs that is absolutely the weirdest encounter, and maybe I shouldn't say the word weird, but one of the KPs that I have spoken with and started building rapport and relationship with that person. Well, he turns out to be a very, very low-key billionaire and was a like US ambassador to Germany at some point in the 70s. So like and like the way he talks is that he wants to engage in conversations around history, literature, and politics. So you really have to be able to talk about politics, like not in like Republican versus Democrat, but at least have some input about public administration. How does the government work? And also like where are things that like social justice can be seen and not seen, and like whether like a civic minded person can do anything about it. So like I, of course like I end up building quite good rapport with that person. I am very lucky because like I like all my degrees in the past were like history degrees. I was originally a historian, so I have a lot of things to say about those topics. But like this is actually a now when I look at it, like this is a very interesting encounter, and it's absolutely like one of the rarely seen KP type that like not every, that I believe that like not everyone would feel comfortable talking to that person with like quoting a lot of books and quoting a lot of like what someone has read like in a Forbes in a newspaper like and in all those like magazines.
Oh yeah. Well, and I find too, to your point, that most KPs are very, very unassuming. Like the two or three that I've met since I've been in the community, I had no idea who they were, and they had very successful 30-year long careers in
Mm-hmm.
multifamily and in buying businesses and whatever. And I'm just talking to them like they're anybody off the street,
Yep. Mm-hmm.
you know.
Right. That happens all the time.
Yeah, it happens a lot. I've managed to, like I said, build relationships with people, and I feel like the example you just gave is a good reason to become a holistic and well-rounded individual, right? Because like I could hold a conversation about history, maybe not as well as you could, but I could, you know.
Mm-hmm.
I could hold a conversation about philosophy or social justice or
Mm-hmm.
whatever occasion arise. And so I feel like that's a all that much more of a reason to just become a more interesting person in general.
Right, right. So yeah, so like I would say read a lot. Uh just like read a lot, think a lot, be mindful of like what is happening around us. Who knows? Like sometimes those would be things that you have an opinion about, and maybe this would be the reason someone would love to work with you when you're sharing like your very deep, deep thoughts with them.
Yeah, and sometimes it's also a reason for you not to work with that person either. I've noticed
Well,
that
that is
too.
very true.
You might totally fundamentally disagree with everything they have to say, and you're like, man, we really wouldn't get along anywhere.
Right, that is very true. I have worked with a KP before, and when I asked her about, hey, how do you think about so and so? Uh, by the way, that so and so is pretty famous in many communities in our including ours. And that KP was like, I am not going to work with that person. His mindsets are all wrong. Well, but what does that incident tells us? Um, KPs are not only looking for knowledge, they are always looking for like mindset, personality, values. So these are all, so like I would say that it is a two-way street. Of course, like KPs are vetting you, but this is also an opportunity for you to vet the KPs as well. So you do not have to always think that you are definitely in an inferior position just because like you have a shorter career in real estate or you don't have a like net worth that is as high. But like this is always a two-way street and like interaction is expected.
I've definitely found all of that to be true.
Yeah.
What kind of big projects do you have coming up on your near and future horizons?
Right. I am focusing on like closing that 138 townhome deal in Louisville, Kentucky. Well, it is a Class A property, so we're excited about it. It is a rare opportunity for us to acquire that directly from a builder delivering amazing results because we don't expect a lot of repair and maintenance fee down the road in the upcoming 5-year hold time. And then I also have a lot of things going on. I would love to be um, like in more like educational series and talks and webinars, like to like talk about multifamily investing, especially like for well, minority women, because like they really deserve the knowledge to financial literacy. And at the same time, I also have a newsletter going on that people can subscribe. If you're interested, please subscribe to steadyworkcapital.com/subscribe. That would be the link to our newsletter that you can register for. And every 2 weeks, I will be covering things I am seeing in the front line with deals, what I am seeing in the market, and I will also include tips about digital marketing that can be useful for investors. For example, in the previous newsletter that we just published, I actually cover how to use like Google image search to find out scammers. So like these are some good tips like that I would like to share with everybody to protect themselves. So happy investing.
And you said that's steadyworkcapital.com/subscribe.
Yes. So it is steadyworkcapital.com/subscribe.
Beautiful. And where can they connect with you on social media besides the QR code that you have posted up there?
Right. So I am active on Facebook and Instagram. So my Instagram handle is at Invest with Mitch. Please follow me, DM me, and we welcome all questions related to multifamily investing. So we like from time to time I post like educational information about multifamily investing on social media. Also, if you have more questions and want to speak with me directly, I welcome anyone to email me directly at info@steadyworkcapital.com. We can always hop on a call to answer any questions you may have. And let me know how I can bring value to you. I'm here for you.
So one of the questions that I really like to kind of give at the end to start winding this down is you're you're sitting face to face with a brand new REI investor, and in this case, we'll say that they're interested in multifamily syndications.
Mhm.
What is the piece of advice that you would give them that you wish you had?
Mm, that is a great question. Um, I have, I would have two advice. One, um, take care of yourself before you see the money. That would be the same of like what I explained just now. Multifamily is a long game. Your big paycheck will come, but down the road it will. So before you see that paycheck, be sure that you don't die before that. Which well, die is a serious word, but like what I mean here is that take care of yourself. Make sure that you have other streams of income and you are not only relying on multifamily as a cash flow before you see the big paycheck, if it is necessary for you to do to take care of yourself and to take care of family. Because multifamily is a long game, it has a lot of money involved, but it is also a very slow burn. Another advice I would give to people is that vet people very carefully. We are not only talking about how much net worth that person has. Many high net worth people has been sued by SEC because of their infidelity. So try to hop on a call, talk to the operators and see how they think. Very often, um, a very like simple conversation would hint to you like whether that person is honest or not. And also, like one gut check I love is that if someone promised to email you something or to follow up with you, just see whether that person really did it. Uh, then like this would very often be the first check of whether that person will really deliver what they promised. Just in case you are still not sure whether that person is believable or trustworthy or not, there are two tools that I um, strongly recommend you use. They are very helpful. One is called Google, and another is called Google Image Search. They technically are one, but yes, the idea here is that I have actually personally had the experience um, of finding a scammer using Google search. And the hint of that elaborated Ponzi scheme is hiding in the third or fourth page of search results, which means that if you search into something, make sure that you look into at least the first 5 pages of search results in Google and make sure that you don't miss anything. Don't just leave the first page and call it good. Also use Google image search to look at to search that person's face or image and see whether that person's real name matches who they say they are. Very often scammers steal other people's images on LinkedIn or on Zillow, for example, and faking an identity. That is actually a way of like protecting yourself from scammers before you give them any money.
Well, you answered my follow-up question before I could answer it, which was going to be for tactical tips. And the image search I wouldn't have thought of, but I mean, it works great. You can just do a reverse image search for anything. That's how I found out what breed my dog was. Like,
Mm-hmm.
so it would make sense that if you sent me your picture, I could download it onto my phone, upload it into the reverse image. If it doesn't come up as Michelle Chu, then I know. I'm like, okay,
Right.
something's wrong here.
Yep, exactly. For example, I recently run into a private money partner who said like they can borrow money to somebody, and a quick Google image shows that like that person is not called Jeffrey at all. That person is not a lender. Instead, like it is a stolen picture from an agent from a completely different state. So like that is how you see that like seeing is not believing nowadays. So like do not trust, always verify.
Yeah. And also to your point, most things will pop up on the first page, but it does not ever mean stop on the first page. Go through,
Yeah.
like you said, the first five. Uh,
Mm-hmm.
Usually, if you have a gut feeling, you have a gut feeling for a reason. Do your
Mm-hmm.
due diligence, do your checks.
Yeah.
More often than not, that gut feeling is usually verified on the first or second page of search results.
Right. Yeah. But like my previous experience, I caught something that is not right, like on the fourth page. So yeah, I would
Yeah.
say, like go to the first five.
Yeah. Go
Yeah.
through the first five no matter what. Um,
Mm-hmm.
But you never know. You might find your confirmation you need earlier. Go through the first five anyway.
Right. Exactly.
Cool. And then is there any other advice, tips, things that you want to leave newer investors with?
Mm, well, well, I think like we have talked a lot. So, by the way, my website also has a deal evaluation toolkit. I would love to offer that as a gift to all the listeners here. Please go to steadyworkcapital.com. There is a page for resources, and it will be available for anyone to download. So, yeah, gift for you all. Thank you.
Beautiful. Well, guys, everybody here knows how we do this. We do these every Sunday afternoon. And we only ask one thing, and that is that if you like this, whether you've caught the recording or you caught it live, you were able to come and ask questions of the guest, that you if we made you think, if we made you laugh, if we brought you value, if we made you smile, whatever it is, that you just come back and you bring a guest next time. So until next time, everybody, y'all have a good weekend, and we will see you next Sunday.
Yep. Thank you so much. I hope to talk to you again.